Welcome back everyone, Jake here. Frequently on my channel, I like to share my success stories with you of trading options. However, I do think it's important to show you of what can go terribly wrong. So in today's video, let's talk about this article I found in Vice, and it's titled, "I lost $400,000. Almost everything I had on a single Robinhood bet." This article's from 2 months ago, and it's anonymous, and my initial reaction to this title is, I think Robinhood is getting an unfair reputation. If you wanted to make these exact same options trades with Charles Schwab or Fidelity, they're not going to stop you from basically losing all of your money if that's what you're determined to do. Second thing is this almost everything. I feel like on my channel I don't mention this enough, but I am primarily an index fund investor. Between my 401k, my IRA, my Morgan Stanley account, and my Fidelity account, the only thing I'm doing is buying and holding S&P 500 index funds. So about 80% of my net worth is just in low-cost, simple S&P 500 index funds where I'm not trying to time the market. It's my Robinhood and Schwab account where about 20% of my net worth I am actively trading. I'm trying to beat the market average that you could get from holding an index fund. And if I completely screw it up trading options in these accounts, I don't think it's going to happen, but I would lose about 20% of my net worth. I wouldn't be losing everything. So I do feel like I need to promote to you as my viewer that you should primarily be buying and holding long-term index funds or very reliable stocks, and then a very small percentage should be speculated with by actively trading options. For this article, I'm going to assume it's a guy, so I'm going to use the pronoun he, and let's get into what he says. And he says, "I was 26 and stupid." And 26 is how old this individual is still probably this year. I wasn't that bright when I was 26, so let's go ahead and give this individual a pass there. "I had arrived in the US when I was 18. I didn't have money and worked not good jobs to get through college. I did the exact same thing when I was in college. I worked at a gas station, I worked at a McDonald's, I worked at an amusement park. These were not glamorous jobs, but it's just something you do. I didn't go to a nice school, and I've worked in sales ever since I graduated. My first job paid me $40,000, next one $50,000, so I basically only started getting money like 3.5 years ago when I got a good job, and I was like, oh my god, this is really great." So kind of reconstructing this individual's adult life, it looks like they went to university at 18, they graduated on time at 22, so they've been a working adult earning decent money, greater than $50,000 for the last 4 years. This is where I'm struggling to understand where they got $400,000 in 4 years from savings, but let's just continue with the article. "I had no other passions other than really earning money, just stacking it up. So I just worked and saved up quite a bit. That's all I did for 3 years, and I just needed something else to do to take my mind off of work. There's plenty of other great hobbies out there, get an Xbox, get a PlayStation, find some other way to unwind when you come home from your job. Because if I kept working like that, I'd go crazy, and investing seemed like a thrilling, fun journey. It was kind of like gambling." Obviously, guys, I've already read this article. Nothing this individual did at any point was actual investing. And in fact, actual investing isn't thrilling or fun to the average person. Buying and holding, dollar cost averaging, index funds doesn't really get the juices flowing for most people. It is long-term, boring, just buy and hold, and you don't have to think about it. But this individual wanted that thrill. You can see right here that they were drawn in by the thrill and the fun, which is just gambling. This individual says, I'm super conservative. I don't spend anything. My monthly expenses are around $2,500. I pay $900 for rent. My three biggest purchases I've made in the last 10 years were my laptop, my car, and recently bought a new iPhone. So I'm struggling to understand this person's income. So if their monthly expenses are 2,500, and let's say they're earning 6,000 a month, that's 72,000 a year, and their expenses are 2,500. I mean, they still have to pay taxes, Social Security, Medicare, federal. So at best, this individual is just saving 3 grand a month that they can put into the markets. That's only 36,000 a year. I'm still foggy how this individual was able to save $400,000 in their 4 years as a working adult. This individual's income recently must have skyrocketed. He says he works in sales, so maybe it's commission based. Potentially that's how he made so much money in such a short period of time. But either way, you're only young once, and if you're making decent money, you can buy a brand new iPhone every 2 or 3 years. It's not a big deal. You can have a nicer than a $2,700 used car if you can afford it. It'll come off as stupid, but I considered myself conservative from an investing perspective. I had $300,000 in a high yield savings account, and I made like $1,000 a year on it. Once again, I think this person is exaggerating because making only $1,000 in interest on $300,000 in a high yield savings account, you should have been getting at least 1%, which would be like 3 grand, but whatever. My job involves a lot of researching companies and trying to understand business and economic models. I like to read a lot, and there are lots of books on investing. Okay, dude, did you actually read any of these books on investing? I don't think anybody would have advised, a YOLO on a speculative stock with options. But I put chump change, like 3 grand, into crypto when I only had 5 grand to begin with in 2017, and I lost all of it. So once again, I'm struggling with the contradiction here of him saying he's always been conservative with his money, yet he says that he speculated on some terrible crypto coin in 2017. If this individual had just put this 3 grand in Bitcoin or Ethereum 5 years ago, I mean, it probably would have 10x'd or something ridiculous like that. This individual says, I work in tech and a lot of my colleagues were worth like $10 million. Seems like an exaggeration. I don't know how everybody that you work with in tech can be multimillionaires. I don't think these companies would be able to retain their employees if they paid them millions. But the big tipping point was GameStop. It was just ridiculous, and I got greedy, and I had FOMO. If ever you guys are even suspicious that you have FOMO on a certain speculative investment, that's red flag number one that you should pause, maybe give yourself 48 hours to think it over. And here's where we get to the individual stock that this person speculated on. It didn't start with Alibaba. It started with a 5,000 bet on AMC, then the 5,000 became 15,000. When I bet on something else, then it became 50,000 when I bet on silver. So I guess this is how the individual got to $400,000 in 4 years. They were making other trades about a year ago when GameStop, AMC blew up. I also remember when there was like an attempted short squeeze on silver. Okay, that's when I was like, okay, I'm done with this. Now I want to buy a safe bet. And the safe bet was Alibaba. It had fallen from 330 to 245, but I had wanted to find a company where the price to earnings ratio was low and every single analyst had a buy rating with like a 40 to 50% upside on it. Looking at all of tip ranks, my understanding was that this was a very, very safe bet with a limited amount of risk. I don't know anybody a year ago who was advising anybody or writing that Alibaba was a safe short-term bet. Jack Ma, the CEO of Alibaba, had been abducted by the Chinese Communist government. So the CEO and founder of this company had just been forcibly removed in December of 2020. So who is telling this individual that Alibaba was a safe bet short term? This individual was terribly misguided. So let's actually try and retrace what happened here. And Alibaba peaked in October of 2020 at around 317, and then after the GameStop AMC short squeezes in February, this stock had fallen to 245. So this individual chose to get involved in Alibaba at around February 24th. And I wouldn't argue that the PDE of Alibaba when it was at 240 was that low. It's low now that Alibaba has fallen in half from that point. It's at 122 a share now. But this 40 to 50% upside, it's all relative of when. When will it do that? So let's continue with what this individual did. Then I just went all in on this one single stock option, the 200 strike price call option on Alibaba. I would describe a call option as a leveraged bet on the underlying stock. I initially invested $300,000 in February, basically every single liquid asset in my account. Not retirement, but everything cash. I didn't have anything left. My thesis was I might not make a lot of money, but I won't lose much. Okay. The downside seemed limited, and that if worse comes to worse, it would go down to like 280,000. So I'll say this when purchasing, when buying a call contract, if the share price of the company is below the strike by expiration, the contract is worthless. What is the risk when outright buying a call contract, and it is 100%? You can lose. Every single time, you can lose 100% of the premium you paid for the contract. Now, this is interesting that this person chose the strike of $200, which at the time was less than $245. So he did try to mitigate risk a little bit by going with a strike that was in the money. So if Alibaba had, which was at 240, fell 10% to 220, by expiration, these contracts would still be in the money. They would still have a little bit of intrinsic value. So this is why this individual is saying, if I put in all this money, worst case scenario, I won't lose it all. I'll just lose, a third of it potentially. Mistake number one. Mistake number two, guys, is this individual didn't do any technical analysis. And I don't think this individual understands anything about technical analysis. So as soon as the 50-day moving average, which is this green line, crossed below the 200-day moving average, the purple line, this is a death cross event. There are lots of large funds that will no longer invest in a stock if the 50-day has fallen below the 200, meaning more than likely the share price is going to go lower. Doesn't matter what the short-term valuation is, P to E, price to sales, or even how decent, quarterly earnings reports that the company is reporting. When a technical event like this occurs, a company can just free fall. It can just continue selling off for months until that stock can stabilize. So this individual, unfortunately, in the article doesn't give the expiration date of these call contracts, but I'm going to guess they went with 6 or 7 months. So if they bought the calls in February, potentially the expiration date, I think, was September or October. So let's continue the story here. The price started to continuously drop almost from the get-go. I was watching it night and day, and it took a mental toll. The issue with Alibaba is it's a dual-listed stock. It trades in Hong Kong and in the US, so all day you're watching pre-market and opening in Hong Kong, and then again in the US, Monday through Friday. You're constantly watching it fall. My mom told me on April 13th, get out today. So if we go to the chart and we go to April 13, you can see that Alibaba did bounce back from 228 to 244. So he was probably close to what he initially put in when he made the bets in late February. So he had to watch this for about a month and a half, and he basically got back to where the share price was. And his mom is telling him, get out. You got most of your money back. You're going to lose $30,000 potentially, but the share price popped. This is your chance. And it might have been ego. It might have just been stupidity, ignoring the facts. But my conviction was high. If you listen to the smart people, they all said it would go up. And this is true, guys, that large, very well-known, successful investors like Charlie Munger and at the time Monish Pabrai, they were investing in Alibaba as it was going down. But those individuals, their holding period, Warren Buffett likes to say his favorite holding period for a stock is forever. So Charlie Munger is buying Alibaba at these prices with the intention of holding it 10 years. He's not buying call contracts with an expiration date in 6 months. So I was like, hey, this is going to rebound. And as my salary came in, I saved another $100,000. Once again, I think this person is exaggerating some of these numbers or we're missing some information. How in 2 months, since when you put in literally every dollar you had, how 2 months did you get an additional $100,000? So in July, I put in almost another $100,000. I basically transferred all the liquid cash that I had and maxed out my account. If my company had not paid me at the end of July, I wouldn't have made my rent payment for August 1st. My mom told me not to do it, and I still did it. When I invested the other $100,000, she told me, sell tomorrow, sell tomorrow, sell tomorrow. I didn't listen. I was stupid. An extreme level of greed and risk-taking. And this is ultimately what drives people to YOLO on options plays, guys, is they want to get rich fast, obviously, and this would have done it. If he had invested a 200 strike when the share price was 240, $400,000, and Alibaba's share price by October when the contracts expired went back to 52-week highs, he would have had several $1,000,000. He would have had potentially a 200 or 300% return on his investment. And you gotta ask yourself, after experiencing success with an AMC trade, a silver trade, and let's say things went right with Alibaba, would this individual really have stopped, or would they have just YOLO'd their now $2 million or $3 million on Dogecoin or whatever the next stupid investment you could make? It's not really investing. So the next 10 days after that, it dropped by another 30%. Options contracts can do that. If options contracts are dependent on dollar movements, not percentage movements. But yeah, this fell pretty quickly for this individual. It was fully out of the money by then. Out of the money means the share price had fallen below the strike, in this case, $200. I probably shouldn't mention this to you guys, but what this individual could have done to recoup their losses after the share price fell below 200 is he could have liquidated his call contracts and then bet the other direction. If this individual, let's say they only had $80,000 worth of extrinsic value in these contracts remaining, he could have flipped it to be at the money or out of the money put contracts and then made money as Alibaba continued to fall, continued to go down. There's a screenshot here of his Robinhood accounts, and this is peculiar to me, shows negative 100% all time. But this doesn't include his AMC or silver trades, so either this is a fake screenshot of Robinhood's account, or potentially he was making these trades with a different broker and then moved all of his money to Robinhood to trade options. I'm not sure. The whole $400,000 turned almost zero. It was at that time that I knew that there was no coming back from this. I was literally begging for it to come back so I could even get $300,000 out. Just praying, like once you go from desperation to literally praying, and I'm not even religious. But the truth was, I was still somewhat optimistic. I still had $75,000 in remaining extrinsic value of contracts that are now out of the money. And I was hoping that Alibaba would make a recovery, which of course it did not. My next thing was, okay, how do I earn all this money back? But it fell from 75,000 to 50,000 and ... I was pretty depressed for like 2 months. I knew I messed up and felt stupid. I was so unhappy that my parents didn't want to make me feel more stupid. Sure, my mom told me off a couple times, but she was also supportive because she knew I was already beating myself up. This person is probably fine. The fact that they were able to earn such a high income and save so effectively over just 4 adult years of their life post-college, I'm not too worried about this individual. I don't know how much they're making and what job they do, but they appear to be pretty good at it and a hard worker. So if they can just stop YOLOing and do real investing, if this person had just taken that $400,000 and dollar cost averaged into the S&P over the last 5 years, they'd have $600,000 or $700,000 at age 26. It's pretty phenomenal. So this person does have some good habits that if they just tweak their approach a little bit, they could do really well in life. I sold and shut down my Robinhood account in October, right before my birthday. I decided I don't want to have this hanging over my head. He did walk away with $20,000. So at some point when these contracts were far out of the money, he sold to close, so the expiration wasn't October. Potentially it was November or December. The day I sold it, I was like, you know what? I effed up. It was a mistake, but clean slate, dust yourself off and move on. I felt better when I sold, much better actually. If we scroll down, this person says something really stupid, and he says, I don't believe in passive index investing. You know how Warren Buffett made a multi-million-dollar bet that the index will outperform a bunch of hedge funds over a decade? My truthful belief is I don't necessarily believe passive investing to be the answer. Passive investing is literally for everyone, and if you want to try and beat the market, just take a small percentage of your net worth, try and trade with that money. What percentage of the world's active investors outperform low-cost index funds over a 10-plus year period? And it's almost none. I mean, the ones that do get books written about them because they're so exceptional, and they are the exceptions. So why this individual claims to be familiar with finance, well-read, and then they still reject passive index investing, I don't know. I'll link the article down below if you want to read more, but this person just gets very preachy and judgmental of Robinhood and other people making similar kinds of bets. And I just don't understand it, but this individual doesn't really seem to express any remorse. They even say, if I had to go back and do it all again, I would still do it. Still, if I could do it again, I wouldn't have put in the other $100,000, but I still would have made the initial $300,000 bet, even if I would have lost it all. Okay. This actually reminds me of the Dogecoin millionaire, the guy who YOLO'd his entire life savings into Dogecoin. It reached a high of $3 million when Elon Musk hosted SNL. And his Dogecoin holdings are now like $300,000 or $400,000. He still has a decent amount of money, but when you ask this guy, do you regret not selling when your Dogecoin was at 3 million? He says no. People would rather, I think when people want to live with mistakes, they have to rationalize those mistakes, and they actually have to believe what I did wasn't wrong and I would have done it again so that they can live with themselves today, which I don't think is going to make you a better investor going forward in the future. If you were wrong and you can analyze it objectively, you should admit to yourself, this was a mistake. I never should have done it. How can I be a better investor, trader, person going forward? Okay, guys, I thought this was an interesting story that I wanted to share with you. If you enjoyed this video, give me a thumbs up so the algorithm knows it's good. If you have any questions or comments, let me know down below. Or if you know of other stories that I could react to or read or share with the channel, I would greatly appreciate that. Till the next video, take care.